Hey guys, today I found a new post from a username Carmelo and Tony. A little bit of wordplay there, I guess. Carmelo Anthony. You really thought he was a pretty good player actually when he played for Denver Nuggets. I guess way back when. um, but so basically, this user is saying that should I take out a personal loan? Should I take out a loan for a new car if I have the money to pay for it? And then basically says I'm looking to purchase a new car. The car is around 35,000, and my parents advised me to take out a $10,000 loan so I don't have to pay it all at once, and as a means to build my credit. However, I do have the money to pay in full, though it would drain much of my savings. Does it make sense to take a loan? Or if I'm able to pay it in full, should I just do that? Edit. Did not expect to uh, did not expect this to gain as much traction as it did. Thanks for the responses. Based on the comments here, seems like the general consensus was that they take out a loan if I could get a 4% or less APR on it. In my case, this 10,000 is sitting in a HYSA high yield savings account at 3.75. So my goal is to see if I can get a loan via credit union, bank, or dealership at a rate less than that, so I can actually gain money from paying it off rather than paying it all at once. If I cannot, then honestly, I don't see why I would just not pay it all at once. Though, seems to be some different opinions about how beneficial it is to take out a loan for credit score. Some for it, some against it. It's no brainer if I can get less than 3.75. But otherwise, it's a matter of do I want to lose a bit of money to help my credit score? LOL. The other factor would be because this helps me not drain my savings, which not now looking back at it, I realize now I enough set aside for a solid emergency fund so I can take the hit. I am very new to this world, so much of these thoughts are a reflection of what I am seeing in the comments, and I'm mainly updating this to help someone who reads this in the future. So first things first, obviously the taking out a loan to get a higher credit score is not necessary. Like there's no reason for you to pay interest just so you can have a higher credit score. As some people have mentioned, credit cards, having multiple credit cards and just carrying that at a zero balance, not paying any interest on it, is actually sufficient enough for you to have good enough credit score. Sometimes the lenders, I think somebody mentioned about buying a house and stuff like that. Sometimes they want to have what they call like the multiple trade lines, meaning like have multiple accounts in the credit sometimes, but it's not a necessary in many cases. Sometimes in the home purchases, maybe there might be an issue. Also, the other thing that they really like is that having a long credit history, meaning if you have had a credit cards for 5 years or 10 years, is actually much better than having this credit card you just opened up about a month ago, and that's the only trade line you have, and that's the only credit that you have, right? So things like that, but it's not necessary for you to have a loan just so you can have to build the credit score, which that doesn't make any sense. You want to use it to your advantage, not necessarily to try to do this, do that. Just to, again, it's kind of like cutting the corners, right? Like if you don't have to do it, like why do that? Just why spend money just to get a higher credit score? Because ultimately, I just don't think that makes sense. In short, the thing about this, right, is that the interest rate from a dealership versus another bank or the credit union, and so on and so forth. Sometimes the dealerships are beneficial, and again, I used to work for a car dealership, so I can say this. That you can actually get a better rate through the dealership than you would otherwise. It's even if you're getting the same loan from the same lender, sometimes the dealership can get you a better rate. Again, even with the same lender that you will go with, whether it's a credit union or a bank or a traditional, whoever it may be, whether it's a manufacturer bank or what have you. And so it's not a bad idea to kind of look into that. just to keep things in perspective, and I'm sure this is not the case anymore just because the inventory levels and how the market is right now. But if you guys remember when there was big advertising on the cars before where it says, hey, get a 0% financing for 72 months versus $10,000 off on this new whatever, maybe Chevy Silverado or something like that, right? There's a big advertising for huge discount or a special interest rate. Well, it is a either or, right? So you either get this or that, so you don't get both, right? And the reason for that is because basically you can qualify as long as you qualify with your credit score, you can get a special APR, special interest rate, for the loan for you to finance with the manufacturer and lender. Or if you keep up that special interest rate of 0%, 0.9%, whatever it may be, you may actually get the discount of the vehicle. So like instead of giving you a special rate, because it works just like any other lender, right? So like there's an opportunity cost as a lender or the financing company, and so they give you an option of, hey, you can get it at 0% or 1% or 2% for how many ever long, or you can get it at actually a little bit of discount. So you can think of it kind of like in a mortgage, like which is a little bit more prevalent, I think, is that you can do what they call the discount points, right? Basically, all you're doing is you're paying for the interest up front, so you actually pay a little bit of less interest over the term of the loan itself, so you get a little bit lower payment typically, right? Because it's a little bit lower rate and stuff like that. And so, again, the pros and the cons of it is you kind of have to figure out which way is better, right? Whether, should I be getting 0% financing just for the sake of getting it, just because it's available, or should I not get the 0% financing, but get additional, use that as a leverage to discount, negotiate further to get a little bit more discount on the purchase price of your vehicle, right? So like again, you just have to kind of determine that and kind of figure out what the numbers look like, whether or not you want to go with special financing versus not special financing. When it comes to spending the money or paying cash for the car or take out a loan for $10,000, I'm not sure where that other $25,000 comes from. Based on what I'm seeing, it looks like you have about $10,000 sitting in your account currently, and collecting about 3.75% interest rate. Now, I'm not sure, again, I don't know, where the other $25,000 is coming from. And also another thing is that I'm not sure if that is the only money that you have, meaning you got to have a little bit of emergency fund. I think you mentioned it yourself. You want to have a little bit of extra savings. And I just couldn't understand what you meant by, I realize now enough set aside for a solid emergency fund so I can take that hit. So I'm not sure what you mean by that. But assuming that you do have additional emergency funds set aside, assuming that you have a little bit more cash, and then you can take the hit of $10,000. I don't know, maybe that other $25,000 is money from your parents, maybe, or there's an equity in the car you're trading in, maybe. Doesn't matter what it is. Let's say we're talking about just $10,000, and assuming that you have more money. If you don't, then obviously finance it by all means. Keep that emergency fund because you need that. But assuming that's all the case, we talk about the interest rate of whether it's 4%, is it 3.75%, which one's good or bad, things like that. What we're talking about basically is opportunity cost, right? So should I just pay it all in cash and not pay any interest because I paid it cash, or keep the $10,000 and take out a loan for $10,000 and pay interest on it, but at the same time, because the $10,000 is sitting in the account, that you're collecting interest from it, right? So that's the opportunity cost there. Another thing to just keep in mind is that the $10,000 that's sitting in your high yield savings account currently is at 3.75, but chances are it's not going to stay there that high for the next how long ever you're going to be financing the car for, whether it's 4 years or 5 years and stuff like that. I'm just going to use 5 years for this example, but it does fluctuate, and it should fluctuate based on what everybody thinks. It may either stay the same, maybe go up a little bit more, just because of where the inflation and stuff like that is. But it sounds like, generally speaking, whether it's by the end of the summer, end of the year, maybe end of the next year or next 2 years, it does sound like many people are thinking that the interest rate will have to come back down. So just keep that in mind as an quote unquote the opportunity cost. As the interest rate comes down in the future, so will the interest rate on your high yield savings account, unless you're thinking about buying maybe a treasury bill or CD at a interest rate at 3.75 or higher. Again, it is a flexible rate, so it does fluctuate as the time passes. And generally speaking, I think most people are expecting the interest rates to come down rather than go up from here on until next so many years. So I wanted to actually run some numbers here just for us to kind of have in the background. Again, I ran the numbers for the $10,000 in balance, and I picked 4% as the rate for the 60 months, which would mean your auto loan payment will be $184.17 per month for the next 60 months, which would mean you would have to pay basically $1,049.91, assuming you're only making the minimum payments on it, right? That's if you kept the $10,000 and borrowed the $10,000 in loan. Now, of course, with your current high yield savings account rate at 3.75, again, assuming it stays the same the way it is, you will be actually, quote unquote, collecting $2,058.78 for the next 60 months or the 5 years. So here in this particular incident or the case, you would actually have a profit over $1,000 of the profit, meaning it makes sense. It seems like that you should take out a $10,000 loan because obviously you'll be making money on that for the next 5 years. But one thing you do have to keep in mind is that, one, because you took out a loan for $10,000, you do have to make that monthly payment of $184.17 every month, per month for every month for the next 60 months. Now, of course, the flip side of that is that if you didn't take out a loan, right, and then if you did use your $10,000, right, then now you have no loan and you have no money in the account, but you also don't have a monthly payment of $184.17 a month. So if you were to actually use that money, which is $184.17 a month, and let's say you made a payment to yourself, as if you're the lender, right? And you made a payment to yourself, and let's say you're still earning that same 3.75% interest rate per month every month. After the 60 month, you would have actually collected $1,120.96, meaning the profit that you would have made by borrowing the money, by keeping the $10,000 in your checking account or the savings account, was $1,008.86, while the opportunity cost, or the benefit in this case, will be collecting $1,100, which is actually more than what you would have gotten or made from taking out a loan and collecting the interest on it. So what that means is that in this particular case, you're actually better off by paying cash for the car and actually pay yourself back at the same $184.17 per month back to yourself for the next 60 months. In this case, again, you'll be making a little bit more money. Again, in this case, the opportunity benefit here will be about, over $100, $110, $112 for the next 60 months, which is very, very little. Again, but if we're looking at opportunity cost, should you be paying it versus not, and that sort of things. Of course, there's tax implications and all of that, but just on the surface, that's what it looks like. Now, that's at a interest rate of 4%. Of course, if the higher the interest rate gets, as you would imagine, as the interest rate of the loan gets higher, the less the profit gets, and obviously the more it makes sense for you to actually pay the car in cash, which is basically what you said. But I just wanted to kind of have a perspective of even if the interest rate was at 4%, that's actually not the case. And I actually did the same number at 3.75, which is actually same rate as if you would have gotten as a as the high yield savings account. And you actually the profit on that is 1,076 versus 1114. Because again, the monthly payment in this case actually goes down. It changes to $183, just because the interest rate is lower, right? So, in this case, you would have actually made still better off by paying cash, but by like $40 or so, rather than $100 some as earlier, and then even at a lower rate of I think I did 3.625. Again, your profit would be 1110, 11. Oh no, oh you're still better off. It's 1110 and 69, so it's better by 58 cents. And then now if you go down to, so yeah, even at a lower rate, even if your interest rate is on the loan is actually lower than the interest rate that you will get on the high yield savings account, you're still better paying cash even though interest rate on that is lower. That's very interesting to find, and it could be because the terms on that loan and the loan amount and stuff like that, but still, even at an interest rate on the loan, your interest rate is 3.625 versus the interest rate you would get at a 3.75 on the high yield savings account. You're still actually better off paying cash because the profit in this case is actually less than what you would have collected by paying cash for the car. So your recommendation would be still to pay cash for the car and collect interest, or pay yourself the monthly payment so you can pay it off, or collect interest from it, or get it compounded. And of course, as the interest rate gets lower, at like say 3.5% or something like that, the profit gets a lot more than what your essential the interest would be, just because again the cost of that is so much lower, right? But so that was an interesting find. Again, like I always assumed, if the interest rate was higher on the loan side versus the savings that I'll be getting, is always better off. But it turns out it's actually not the case. Like even at 3.6, you're actually better off paying cash just because of the opportunity cost, right? Of course, I'm sure it's very, very difficult to find a loan at an interest rate that's lower than what you'll be getting from the high yield savings account, which is very, very difficult to find. I'm sure you can find it. It's just that's what that is. Now, another thing to keep in mind is that when you take out a loan, you can actually pay off faster, so you don't have to make the minimum payments only, and you can do that. And it depends on when you do it and how aggressively you do it. Obviously, you end up paying less, meaning your cost goes down, and your benefit goes up and stuff like that. So, but that's interesting math to kind of figure out. So, that's something something to consider. Hope this helps. When you're making a decision about whether or not you want to pay cash for the car. This goes out to tell you that you always want to do the math, right? So you always want to do the math to kind of see, what is at what level does it benefit me versus doesn't it not benefit me. So hope this helps. Please leave me a comment and then we can go from there. Thank you. Please consider subscribing.